Welcome back to the Texas Home Loan Hustle, where we keep it real about mortgages, money, and making home ownership happen. I'm Melissa, and today we're breaking down the real numbers behind two of the hottest topics in home buying right now: assumable mortgages and 2-1 buydowns. Why are these such hot topics? Because affordability is tough right now. Everybody feels it. Builders and sellers are getting creative with helping buyers stretch their budgets, whether that's through short term relief with a buydown or long term savings with an assumable loan. Here's my sidebar conversation on affordability. Too many people think it's only interest rates causing the problem, and that's not the full picture. This isn't just coming from a mortgage professional. This is the perspective of someone who's lived it, someone who bought a home in 2014 and again in 2024. I felt the pinch, and I'm currently feeling why. Well, let's talk about what changed today. I'll tell you what changed is the overall cost of living. Food, clothes, gas, everything is more expensive. And then add on property taxes and skyrocketing insurance. Those increases are hitting harder than the rates themselves. And here's the thing, not enough people are talking about that because everyone is fixated on interest rates. Yes, the interest rates are higher, nobody denying that, but the cost of living has increased and is higher than ever. That includes what I call the silent DTI killer: property taxes and homeowners insurance, too. Anyway, I digress, of course. Let's talk more about how sellers and builders are keeping deals alive in today's market. Two tools are standing out right now: assumable mortgages and 2-1 buydowns. If you're not familiar with those yet, don't worry. We're about to make it plain. Let's talk assumable mortgage first. So, the question is, what is an assumable mortgage? An assumable mortgage can be a real cheat code in today's mortgage, depending on the property and equity gap. An assumable mortgage is when you take over the seller's mortgage. You keep the same balance, same terms, and same interest rate. Instead of applying for a brand new loan at today's higher rates, you as the buyer step into the seller's shoes. Eligible loans are primarily FHA, VA, and sometimes USDA. Conventional loans, like those backed by Fannie Mae or Freddie Mac, are usually not assumable unless the lender explicitly allows it. Here's a simple illustration showing how an assumable loan compares to taking out a new mortgage. New loan at 7%, about 1,663 month assumable loan at 3%, about 1,054 month assumable plus gap loan, covering 100K difference at 8% to 15 years, about 2,010 month. This shows how even with the extra financing for the equity gap, the assumable option still saves money compared to a full 7% loan. I personally think if a borrower is going to pursue any savings related to the rate, assumable mortgage loans are the way to go. The savings add up fast. Over 5 years, that's more than $30,000 saved. And that's why buyers and especially investors are paying attention. For buyers, it means a more affordable path to ownership. For investors, it means stronger cash flow on rentals in a high rate environment. My least favorite, 2-1 buydowns. Do I like them a little? Sure. But here's my problem. Builders love handing these out to squeeze folks into a mortgage instead of offering them to the people who could really benefit. So what is it? Basically, the seller or builder pays to drop your interest rate for the first couple years. Sounds nice, right? $350,000 house, $325,000 loan amount. At 7%, your principal and interest is about $2,163 a month. But with a 2-1 buy down, year one, rate drops to 5%, payment $1,144. Year two, rate at 6%, payment $1,949. Year three and beyond, right back to $12,163. So yeah, you're saving about $7,500 in those first 2 years. Not bad. But here's the catch, and why I side-eye these deals: you've got to be ready for that full payment when it bounces back. Unless you refinance, this is just short-term relief, not a forever fix. And if the builder only used it to make you fit into the payment today, you might be in trouble later. Why do 2-1 buydowns puts you in trouble later? Yes, here we go again. That silent killer nobody is talking about called escrows, property taxes, and insurance, especially in Texas where property taxes are the highest. Because here's what's really sneaky in 2025: insurance and property taxes. I call it the silent DTI killer. If you don't know what DTI is, that's your debt to income ratio. Basically, how much of your monthly income is already tied up in bills and payments. And while everyone's staring at interest rates, insurance and taxes are blowing up people's budgets. Here's a real life scenario. Buyer expects insurance to be around $200 a month. Final quote comes back at $700 a month. That's a $500 jump, which means their total monthly payment jumps from about $1,900 to $2,400. And just like that, their DTI ratio is shot, and sometimes they don't even qualify anymore. That's why you can't ignore insurance and taxes. You've got to get quotes early before you even make that offer. And don't just call one company. Get 3 quotes. Ask about prior claims. Check flood zones, wildfire zones, hurricane risk, because these 2 costs can make or break your deal just as much as the interest rate. So here's the bottom line. A 2-1 buydown can give you short-term breathing room. An assumable mortgage is long-term savings, sometimes tens of thousands of dollars. But insurance and taxes, they're the silent killers of deals right now, and nobody's talking about them enough. I've lived it. I've bought homes in different markets, and I've seen the numbers. Rates are important, but they're not the whole story. If you want me to break down what your full payment would look like, including principal, interest, taxes, and insurance, reach out. And as always, hit that like, share this with someone who's house hunting, and subscribe so you don't miss the next Texas home loan hustle. We're here to keep it real and keep you ready.